When marking swing highs and lows, is it just mark the highs and lows of the 1 hour, 4 hour, and the 1 day? Is this the correct way? Simple answer, yes, it is. Because when we look at the high and low of the previous day, let's say this is the 1 day candle, if we were to zoom in on this previous day's worth of price action, so let's pretend that this is a green candle. Okay, if we were to zoom in on this price action on the 1 minute time frame, this is how it's going to look like. So we've got open, low, high, close. Okay. I tried to be as straight as possible with drawing these lines. So the day opened, it made a low, it made a high, and then the day closed out somewhere there. Now, what was the highest point during all of this? Like, what was the extreme high? Well, it was this. What is the extreme low of all of that nonsense that happened in the previous day? It was that. So we have like a pretty significant resistance level, and we have a pretty significant support level too. So 100% I would recommend using the high and low of the 1 hour, the 4 hour, and the 1 day. This is like the easiest type of approach that you can use, because instantly you have 3 different support levels to work with, and you have 3 different resistance levels to work with. You're drawing them in the exact same way every single time. Everything is super consistent. Everything is easy peasy lemon squeezy, right? So very, very good way to start off with. Now, as you get a little bit better, what you will notice is that the actual time frame that you pick doesn't matter that much. What matters a little bit more is what is the time spent away from the level. So for example, how much time was spent from where price is now to this resistance level? It might be 5 hours, 30 minutes. Okay. What about from this, where price currently is, to the support level? Well, this might be, let's say, 17 hours, 17 minutes, right? So the more time that price has the more time that price has spent away from a level, this means that the more opportunity the market has had to go and place limit orders at that particular level. Now, if there was more opportunity to place limit orders at a level than at another level, that means that assuming all other factors are equal, again, this is an assumption, right? Assuming all other factors are equal, and in markets they never are, but we're just going based off theory. Assuming all other factors are equal, the more time that price spends away from a level, generally speaking, this means that we can assume that there are going to be more limit orders placed at that particular level. So if we can't open the order book, if we can't open the order book and literally see what is actually what is actually available at this price, we will see a certain value. But let's just pretend that we can't see how much is actually stacked on the book at this point. And we can't see how much is stacked here. What we can just guess is that we can assume a more violent reaction at this level rather than that level, because there's simply more, price has spent a longer amount of time away from it, which means that there is more opportunity for other players to draw a level there and make a predetermined make a choice that if price was to get to this level, I'm going to make some kind of decision. I'm either going to open a trade here or I'm going to close a trade here. But nonetheless, I've drawn a level at this point and I'm going to execute some kind of trade there, right? The more time that price is spent away from the level, the more decisions can be made at that level. And when I say decisions, what I can translate translate that into is market orders being executed at that level. Again, this isn't always the case, but this is just like if you were to generalize and assume that all other factors are true, it's generally like this, right? Basically, what this means is that you don't have to be as rigid with using 1 hour, 4 hour, or 1 day levels. You absolutely can use the high of the high that happened 17 days ago. Like this is still functional as a resistance level to use to make some kind of decision on. It's just that if you are using a level like from that long ago, you have to be prepared that we're going to maybe have a very violent reaction, right? Because the more time that price spends away from a level, the more violent of a reaction we can assume, because there can be more limit orders at a level and more decision making in the forms of a market order being executed at that level. So the simple answer to this question is yes, just stick to the 1 hour, the 4 hour, and the 1 day. But as you get better, you don't have to be as rigid to using these levels. You can use any swing high and any swing low, but you just be mindful that the bigger the level, the more violent the reaction, which means you might be able to get away with a really nice pop to the upside, and maybe you can get away with holding the position for a longer period of time or going for a wider target. But if your trade goes wrong and it's starting to move against you, you're going to have to cut that trade a little bit earlier and be prepared that if I don't cut this whole thing might roll over. So there might even be opportunities to go short on the way down. But again, this mainly applies to the really big levels. Okay, I'm going to wrap up there, but hopefully that answered the question in a simple manner and also the more complex manner as you get more advanced over time.